We know that China imports about, $300 billion of semiconductors annually. How long will it take for China to be able to close this gap?
Yeah, no, thank you, and good morning. I think for China, they actually have been making quite a bit of progress over the past year. You're seeing it from a lot of the domestic companies. Growth has accelerated quite a bit. I'd say at this stage, though, that the traction, it's really on some of the more mature technology, both the local foundries, the test and packaging, and IC companies, really developing things like image sensors, microcontrollers, consumer chips, and some of the lower-end smartphone chips. So they have made progress. They're growing quite a bit. In some way, though, it gets back to what you were discussing earlier. There have been some restrictions from U.S. in terms of advanced tools, restriction on M&A, and that has been limiting China to some extent, developing some of the learning to develop advanced foundry or to make some of the high-end tools. So from that perspective, yes, I think the restrictions probably means it's going to take time, and we'll need in some of those negotiations eventually some of the restrictions to loosen for them to really close the gap.
In the meantime, they're pledging to make all of these investments in the sector, and that also means those big companies, chip makers like SMIC or Hua Hong Semiconductor, will need to spend more on research and development. How much will that hurt their bottom line?
Yeah, I'd say for SMIC Huahong, there have been good support. So we've actually seen in R&D those amounts that the government is willing to grant for these strategic projects have been increasing. So despite the high investment, I'd actually say the support they're receiving has also been able to offset that. But a second factor, the mature lines have been kept quite tight. In a way, the industry strength on all of this demand, lifting all boats. So fabs are full utilization is helping. Now, in terms of CapEx, I think as long as they're spending on the mature nodes, they can earn a good return. In a way, the U.S. restriction on the most advanced tools, that's where it's quite expensive, takes quite a long time to return investment. But on the mature nodes where actually they can still invest, they can still earn a return and actually keep that capacity pretty loaded.
So, Randy, as you point out, it's been 2 decades of focus from China on this industry, right? When do we see, or when do you see, I should ask, critical mass for the industry?
Yeah, I mean, we've actually gotten to a stage where there's actually a decent ecosystem. One leverage you could say is China as the factory. That was the first part. They've really done quite well, starting with manufacturing. A lot of hardware components, China's moved up the value chain. And now that's given a good domestic base. China's about 20% of volume in a lot of tech end markets. But actually, the China brands have about 30–40% market share. So there's critical mass even supplying into the domestic market. So I'd say actually on a lot of mature parts of the industry where they can access tools, talent, IPs, they can develop the chips. I still go back to the very advanced nodes. On that way, there's still a bridge to Taiwan. They can still go to Taiwan foundries to make the advanced chips. But I think they still need that bridge, you could say, to have critical mass across industry.
When you take a look at what's happening more broadly across Asia on the demand side, is there a case that we'll see continued supply tightness?
Yeah, there is a good case for that. I'd say right now, this is about a 20-year high in terms of tightness. We haven't seen these type of constraints really since 99, 2000. What can continue on, so what broke 2000, Y2K, all the emerging carriers, what can continue on, we're actually early cycle for auto industrial coming back. Smartphone volume was actually down last year. So smartphones set to recover. We're in the second big year of 5G ramp. And I'd also say ongoing is a lot of the cloud demand. So our take, at least demand drivers, look to continue throughout this year. Inventory exited the year at a quite low level. And I would say coming out of COVID, supply chain would actually rather carry more inventory to manage bottlenecks. So to that extent, we do expect the industry to stay pretty tight throughout this year.
So we heard that U.S. and China chip makers were getting together for one reason being that they want to talk about the supply chain and the tightness in the markets out there as well. This, of course, really taking the focus that perhaps we could see a little bit of thawing of relations between the U.S. and China. What do you expect from the private sector when it comes to these bilateral tensions?
Yeah, I mean, the private sector objective, and I would say from U.S. Semiconductor Industry Association, their goal is really to enable business for the U.S. chip companies. So they don't necessarily like to see broad restrictions to prevent some of the emerging China companies accessing technology. I think where we're looking for is some degree of compromise. And to that extent, from U.S. industry, to be able to supply a lot of the mainstream technology, where I think we could still see a bit of tension. The most advanced tools, it does look like from a government perspective, there could be still restrictions on that. So from industry perspective, I think they want to keep as broad a blanket as they can to be able to supply technology and keep the amount that's actually limited to a very short or small magnitude.
How concentrated is the market right now when it comes to supply? There were some concerns that perhaps Taiwan was taking too much of the market share.
Yeah, I mean, in a way, from advanced technology, it's become a reality for the industry. Just a few manufacturers really have high market share in production. From a concentration, Taiwan foundry, about 65% of the industry foundry capacity. So it does have a high market share. Now, what you could also say, though, a lot of the sectors most constrained, things like automotive, a lot of those chips are actually still made in traditional fabs and even at a number of the chip companies across US, Europe, Japan. So advanced capacity, though, that is concentrated. Because it's very expensive to add capacity, there's a very high barrier on advanced capacity. That will not change too quickly or without a huge amount of capital.